Edmund Moy is former director of the U.S. Mint, a position he held for a 5-year term. He served with both Secretary Paulson and Geithner during the financial crisis and 2008 and 9 recession. So that was a period of time, you might remember, that was marked by corporate bailouts, banking failures, and of course, a really huge decline in the stock market. During that time, he earned the Alexander Hamilton Medal for Public Service awarded by then Secretary Henry Paulson. Prior to that, he served nearly 6 years as Special Assistant to President Bush. He was part of the White House transition team and had responsibilities consisting of recommending appointments to most of the major cabinet departments and also many of the independent agencies. His job included regular briefings with White House staff, with Vice President Dick Cheney, and also with President George Bush. In addition, he headed up the federal government's managed care office. That was under the U.S. Department of Health and Human Services. He was responsible for managed care policy, regulation of the HMO industry, and integrating managed care for seniors in Medicare. Now, he's had an illustrious public career, but he's also had an exceptional private career in the private sector. His private sector experience includes an executive at several healthcare organizations, as well as currently serving and then serving on a number of corporate boards. He's been a commentator on Fox Business News and various national publications providing expert analysis on the markets as well as monetary and fiscal policy. So it's a great pleasure. Let's bring up Mr. Edmund Moy.
Thanks so much, Paul, for those kind and generous words. But I'll tell you, you can say all the nice things about me, but I'm no longer Mint Director, so you're not going to get a free sample today. And it's a shame because I did bring 2 samples. This is a solid gold bullion coin that the United States Mint makes, which we sell to financial investors. And this would have been yours, but Paul, maybe some other time. Okay. But for the rest of you, if you've never touched a gold bullion coin, please come up afterwards. It's the only way I can get people to be friends with me. So please come by, and you can hold one in your hand, but you can't keep it. It's not a free sample. One of the questions that I get asked very often is, what is the highlight of being director of the United States Mint? And it's kind of a personal question because they normally bring up a wide variety of things that I could point to. One is turning the Mint around financially so that it earns more than $1 billion of profit a year that benefits the taxpayers. Another one is that I revitalize the Mint as a good place to work. We ranked 211 out of 217 agencies when I joined the Mint, and when I left, we jumped up to 57. Another thing is coming out with different collector's coins and all that other stuff. What's the best part about being Mint Director? And I would have to say all those things provide me with good memories and a strong sense of satisfaction, but it doesn't even come close to having my father change his opinion about me. Before that, every time I was on the verge of making like a lot of money in the private sector, I would always get a call from a president saying, Ed, I really need you to come, drop everything, take on this government appointment and change Medicare, or do this or do that. And I would always accept the call and change my life from private sector to public service. And my dad's always been disappointed because he's wanted to brag about me. And now, finally, when President Bush asked me to become the Mint Director, I said, Dad, you wouldn't believe what just happened. I'm going to become the 38th Director of the United States Mint. And my dad looked at me and he goes, finally. My deadbeat son, you're getting a job where you make a lot of money. I didn't have the heart to tell him that none of it's mine, that I don't even get a discount off my own product. Further, you've listened to that generous introduction of me, and you might think highly of me, but let me give you a little insight on how Washington works. The amount of power you have is inversely proportionate to the title you have. So the shorter the title, the greater the power. Let me give you an example. President, Mr. Secretary. My title when I worked at the White House was Special Assistant to the President and Associate Director of Presidential Personnel. Saying that, it was a great run and an honor and privilege to serve you, the American people, at such a consequential time. And what I wanted to do over the next half hour or so is answer a couple questions that I typically get, and then finish by opening it up to whatever questions that you have. I'd like a period where you can interact, and you can ask me any question you want on why do we still have the penny, or any of those type of questions is open season. So let me start out by saying, how does one become Mint Director? That's a pretty common question. There's only been 38 Mint Directors in our country's history. The Mint was authorized by the United States Constitution, and the Mint became incorporated in 1792. So it's the oldest government agency besides the Department of Treasury, and one that was directly authorized by the Constitution. And since then, there's only been 38 Americans who have ever served in that position. I'm lucky to be the last one so far, and number 38. And each of us come to that job with a different set of experiences. The first Mint Director, his name was David Rittenhouse. And for those of you who have been through Philadelphia, may remember that there's a big square right in the center of the city called Rittenhouse Square. Rittenhouse Square was named for David Rittenhouse, who was next door neighbors for George Washington, Alexander Hamilton, and Thomas Jefferson when Philadelphia was the capital of the United States. And so when the Constitution authorized the establishment of a mint, they went to the most premier scientist in the country. This would be the equivalent of being the top Nobel Prize winner in the United States. His name was David Rittenhouse, and he did a number of firsts, like he was the first one to chart the orbit of Venus around the Earth. And he was commissioned by the world, all the world governments, in order to do that research. He became the first Mint Director. And then all the way to myself, number 38, who, when I became director of the Mint, they could make currency really, really well. They just didn't know how to navigate the future of electronic transactions and a number of other things. And the expertise that I bring is not only business expertise, but being a strategist and helping them navigate through all of that. So each come from different ways, and I want to tell you how I got there. And that was, I had been at the White House. I was one of the people on the Bush transition. So after the contested election was settled, the president-elect puts together a team to help plan a smooth transition of power. And then I became one of the first White House employees with the president. And my job was to advise the president on how to fill all the political vacancies, whether or not it was the Chief Justice of the Supreme Court, to who should be the next Secretary of Labor, to who should be the OSHA head and the Surgeon General. And I would sit down in the early days, virtually multiple times a day, with the president, the vice president, and the chief of staff, and discuss what vacancies needed to be filled and what they were looking for. Then I would interview candidates and then come back to the president and said, based on your specs and based on what the country has, these are the 3 or 4 different people that I want you to consider. And then he would select one, and then it was my job to implement that and make sure that they got placed. And this is what you see is a typical meeting of presidential personnel. To your left is President Bush. You're sitting where the fireplace normally is. And then on the right is Vice President Cheney. To the right of the Vice President is Andy Card, who was our Chief of Staff for 6.5 years. And as you see, that's the Oval Office with the very famous Resolute desk. Back by the window, the Resolute desk was the one that you have the famous life photograph of John F. Kennedy with John peeping through the door that's been used by presidents ever since Rutherford B. Hayes. And then you see some personal mementos. Every president gets to decorate the Oval Office in such a way as to show the things that are important to them. And let's see, on the right side, toward the back, you see a bust. That is the bust of Winston Churchill that was on loan from the British government. And above that, you see a painting. The painting's name is A Charge to Keep, which was inspired by the Charles Wesley hymn. And beneath that, you see a little plaque, a frame with that's white. Those are the first two stanzas of A Charge to Keep, and that's what inspired the president on his spiritual journey. You also see the Remington bucking bronco, which symbolizes the ride that you're going to get when you're president of the United States. And above that is a very personal painting of his of a bluebonnet field, which reminds him of Texas. And you can always tell that when he's under a lot of pressure and he needs to get his mind off, he'll just stand and the bluebonnets will give him some inner peace. Typical meeting, you see me by the Resolute desk. I sit in line of sight with the President of the United States as I manage the meeting, and part of it is because if the meeting's not going well and somebody is taking too long to explain something, the President will give me the look, and then I'll go, Kathleen, you need to reduce this down to a phrase. What are you trying to say to the President? And then I'll get the nod, and then we move on. So that kind of gives you the flavor of what my 6 years were working in the White House. Also, I had worked myself into a position where I was responsible for about 2/3 of all the appointments that the president made. And the president trusted me with even the most sensitive situations. I can't talk about why we're meeting with the president alone, but I had many meetings with the president, one-on-one, to discuss very sensitive issues. And this is a sample of that, where you see me and my aide who, in back of me, who the president was very inclusive in his decision-making. When you were pitching him on something he needed to decide, he wanted to make sure that everyone who had any information that you could possibly need in order to make that decision was in the same room. Because the worst thing was, you go through this whole thing and he said, well, what about this? And then you'd say, I don't know, sir, I'll look that up. Then he had to delay in making that decision. So every time the president needed to make a decision, he wanted everyone there that he needed. And this was a perfect example of that. I was also at the White House during 9/11. And that's a whole different story, so if you want to hear that, invite me back. But one of the results of being at the White House at 9/11 was to see a change in the presidency. Everything that President Bush ran on, from education reform, a tighter military, all those things were still important, but they were secondary in importance to protecting the American people from further terrorist attacks on our own soil. And one of the conclusions that he came to was we might have had enough information to figure out that 9/11 was supposed to happen, except that that information was caught in 22 different parts of government that were each siloed, protective, and not willing to share information with each other. And so I was part of a small group of people that he convened in the Oval Office, and he made clear, after he got all the reports back, he said, I've come to one conclusion. We should take those 22 different pieces of government, put them all under one roof, destroy the silos between them, and force them to work together, because that's the only way that we're going to prevent future terrorist attacks. And I was part of the group that then formed the first new cabinet department since 1947, when the Department of Defense was formed. And so we formed the Department of Homeland Security. And just to show you the type of pressure that you're under, the president in this meeting looked at all of us and he explained his rationale, and he said, hey, listen, I'm a business guy, and I know that 75% of all mergers and acquisitions fail, and only 25% either come even close to what you thought, and then a couple of them actually do better. We're trying to do 22 at the same time, and this is federal government. But here's what's at stake. If we don't do this right, American lives may be lost from future terrorist attacks, and I don't want that on anybody's head. So you guys, you do your jobs well. And that was our charge as we formed the Department of Homeland Security. So from being at the White House, initially staffing through the change of administrations, being involved in critical, sensitive situations on behalf of the president, and helping him form the Department of Homeland Security. After 6 years, I turned in my resignation and said, Mr. President, I have been approved to adopt a daughter from China, and I didn't wait my whole life to let somebody else raise her. And so I don't want to spend any more 18-hour days, 7 days a week. I want to spend more time raising my daughters. And he looked at me and he said, well, Ed, I understand your decision. I really hate to lose you. You've been helping placing all these people in all these different great jobs. Is there one out there that you want to do that would give you more of the lifestyle that you want? And so I gave him a short list, and the next day he calls me, and my phone lights up, and it's typical. We had LEDs at the time at the White House, and it lights up POTUS, for President of the United States. So I pick it up, and 9 times out of 10, it's the president's personal secretary, and she'll say, Ed, he's on the line. He wants to talk to you about this. And then click, and there's the president. So I pick up the phone and go, hey, Ash, what's going on? There's a slight pause on the phone, and it goes, Eddie, this is the president. Yes, sir, Mr. President. I talked it over with Secretary Snow, and we think you'd be a great director of the United States Mint. Congratulations, you're going to be the 38th American that's ever served in that position. I was completely dumbfounded, and he said, you're normally not so quiet. This was on your list. This is something you wanted to do, isn't it? I said, absolutely, sir, but when I said I was starting a family and I needed a job that made a lot more money, I meant my own money, not the country's money. He made a good laugh over that, and he says, all right, you're going to do great, just don't screw it up for me. And then he hung up the phone, and that was the last time I talked to him as a White House staffer. So that's how you become a director of the Mint, and the next thing you know, I was nominated. The Senate Banking Committee had a hearing set up 2 weeks with other banking nominees. I joined into that hearing, and then I was confirmed a week after that, and then sworn into office on September 6, 2006. By then, the new Secretary of the Treasury, John Snow, had resigned, and Hank Paulson, the chairman of Goldman Sachs, became the new Secretary of the Treasury and my direct supervisor. And so I was the first person that he sworn in. That's my wife, Karen. And she's got that really practiced look of the political wife, looking like she's paying attention there. But I was being sworn in as the Mint Director. So you may ask the question, what does a Mint Director do? Well, for one thing, the Mint Director is pretty popular. You can see that pretty big crowd that's with one of our coin launches. The Mint basically makes the country's currency. And with that, it started off making the country's coins. There are 3 types of coins that we make. Circulating coins, which are the rolls of quarters that you get at the bank. We also make collector's versions of those circulating coins, as well as commemorative coins that Congress authorizes us to do. And then third, we make precious metal bullion, like what I just showed you before, the 1-ounce bullion coins. During my tenure at the Mint, the Mint revenues, so the business model works like this. Circulating coins, we get paid face value. So we lose money on pennies because it takes us 2 cents to make, and they pay us 1 cent for it. But we make monies on quarters because quarters take us 10 cents to make, and they pay us 25 cents for that quarter. We also make money by selling those collector's coins on a retail basis, and we also make money selling precious metal bullion to financial investors. And during my time at the Mint, we went from $2.3 billion of revenue to almost $5 billion of revenue. We ended up turning over a profit of $1 billion a year, and that all goes back to benefit the taxpayer. We don't keep that profit. It goes into the general fund of the government to offset the expenses. Funny side story about that. I was so proud to implement some of these things that resulted in $1 billion of profit. And once the auditors went in there and confirmed that it was $1 billion of profit, one of my good friends and golfing buddies, Mike Levitt, who was our Secretary of Health and Human Services and the former governor of Utah, we were golfing, and I said, Mr. Secretary, you need to know that I've implemented some of the advice, and in the end, the Mint tripled its profit, and we got $1 billion of profit. He smiled and he put his arm around me and he says, Ed, that's really, really great news for the American people. Now, I know you, and I don't want you to get a big head about it, so let me put it in perspective. The Department of Health and Human Services wastes $1 billion in the first 4 hours of every day. I mean, that tells you the scale of government these days. So the Mint ends up having 2,000 employees. It's spread over 6 facilities. We have Denver, the Denver Mint and the Philadelphia Mint, which make our circulating coins. We have our San Francisco Mint, which makes our collector's coins. We also have the West Point Mint, which makes our precious metal bullion. And then we have an administrative headquarters in Washington, D.C., along with the mints responsible for protecting our nation's gold reserves. And so I have some gold reserves in Denver, I have some in West Point, and I have most of it at our Fort Knox bullion depository. So I had oversight over Fort Knox for 5 years, which was very interesting. I could tell you whether or not there's gold there, but I'd have to kill you all. So I'd rather enjoy you living, so you can ask me that question later. The interesting thing about being Mint Director is I'm also, so I'm part of the senior management at Treasury. The Secretary has a weekly meeting where he meets with all his heads of all the different agencies, the IRS, the Federal Debt Service, the Controller of the Currency, the Treasurer, myself, etc. And we deal with the issues that are coming at the Department of Treasury and what the national policies are. We also take a look at all the data and try to interpret it. And because I make currency, I work very closely with the Federal Reserve. So I have multiple meetings every month with the Federal Reserve. I'm basically working with them on what their orders from the Mint are going to be. Then I make that and then deliver it to the Federal Reserve, who then distributes it to its member banks, which eventually gets to Starbucks and Safeway when they order change. So that's what the Mint does, and it gave me a bird's eye view of the financial system in the United States during the largest crisis since the Great Depression in 1929. So what were some of the issues that we had to deal with there? Well, the Mint actually forecast some of the problems that we were going to have. And one of the ways it did that was prior to the financial crisis, there was a huge drop in demand for circulating coins. Like not a 10% drop, a 50% drop. And overnight and sustained. And so in dealing with the Federal Reserve on this, the Federal Reserve was saying, yep, Ed, we predicted this before, and it's finally hitting. This is electronic commerce, credit cards and debit cards taking over and forcing cash out of the system. And so this is just a new world that you're going to be in. But that type of drop over that sustained period, that's not a logical explanation. And what we ended up finding out was the drop in coins was because coins are really used in retail transactions. You don't pay your taxes with coins. You buy stuff and you get change. And what was happening was the number of retail transactions was diving downward, and as a result, Starbucks didn't need as much change, and the change was lasting longer and not wearing out as quickly because it wasn't being used as much, and therefore you didn't need as much coinage. And what we eventually found out was that electronic commerce has increased, but it's increased at the expense of checking and not at the expense of cash. Cash is still roughly 1/3 of all transactions out there. So that was the first sign that something wasn't going right. And so this was beginning in mid-2006 to the end of 2006. And then I remember specifically an instance where I was telling Secretary Paulson about the rise in the demand for gold and silver bullion. Like we were getting it's not like a 5% increase, we were getting like 30% increase, 40, 50, 100% increases in the demand for bullion. And he kind of led me through, being the chairman of Goldman Sachs and a lot brighter than I am in this. He said, I understand that, Ed. Why do people buy bullion? I said, well, because of greater uncertainty. Do we expect greater uncertainty? Yes. He said, then what are you doing to increase your capacity to be able to create enough coins to meet that demand? I went, boop, the light bulb went on. What he didn't tell me was, behind the scenes, he had been dealing with many of the titans on Wall Street, indicating that they were all getting into trouble. And at first, we took the position, this is the free market, you made some bad bets, you suffer the consequences of those bad bets, and that's why we let some financial institutions fail at the early point of this. And then it became obvious that this was a systemic-wide problem. And systemic meaning it's just not a company or two, that there were infrastructure that connected all of this so integrally into the economy that any failure would have a cataclysmic effect on the global economy. And so we went through all these heartbreaking discussions about, on one hand, letting the market work, because eventually the banks who made bad bets will go out of business, somebody's going to buy their good assets, and no one is going to buy their bad assets, and a new bank's going to rise up in its place, stronger and better, etc. But at the same time, it was so systemic that if you didn't fix that problem, the whole world economy could crash. And that was what we talked over as what's called moral hazard. So moral hazard basically is the concept that if you end up bailing out someone who's done something bad, you're basically encouraging them to do more bad behavior, which we didn't want. That's the moral hazard of intervening and helping and bailing them out. On the other hand, if you didn't bail them out, you would have worldwide depression that you might not recover from for 25 years. That was our choice. And being a Republican administration with a titan like Hank Paulson, being former chairman of Goldman Sachs, and an avid free market advocate, as well as President Bush, they were loath to go the bailout route. But that was the decision that they made because they didn't want to risk the other problem, which they thought was much worse than the moral hazard. So that's what I experienced at the table during the financial crisis. But that wasn't it. What the financial crisis then begot was the Great Recession that we ended up having. And with the Great Recession, that began toward the end of Bush's term and then escalated during the beginning of Obama's term. And what did we have there? At the very beginning, when President Obama was elected, there was a lot of goodwill, and President Obama pushed through a $700 billion stimulus package, which comprised everything from cash for clunkers to ways to bail out the auto industry, et cetera, et cetera. And so that was passed, implemented, but the results weren't making much of an impact. And by that time, there was a great debate between the Congress and the president on what the best way forward was, and a great debate, partisan-wise, between the Republicans and Democrats on what the best way forward was. And in the end, as you know, Congress has not passed a budget for 6 years. And as a result, the Federal Reserve, which is an independent agency, needed to step in with what they could do with monetary policy in a much bigger way than what they would have had to have done if Congress and the president had worked out their budget differences. And so with that, the Federal Reserve began an extraordinary, like never done before, unprecedented ways to stimulate the economy just using the money supply. And with that, the first thing that they did was cut the Federal Reserve rate down to virtually zero, so it makes it easier for banks to borrow money from the Federal Reserve. And that wasn't doing enough. And so then they began their program called quantitative easing, where they would go to financial institutions and buy their government bonds and their mortgage-backed securities, give them cash for those. Then the Federal Reserve would hold them on their balance sheet, and hopefully with the cash, these financial institutions will loan more and therefore stimulate the economy. And then eventually the idea is then sell them back the government bonds and sell them back the mortgage-backed securities. We printed money to give them the cash, and once they buy it back, we'll take that cash, zero it out, and then no harm, no foul. So that was the plan. But what they found was QE1 didn't work. QE2 began working a little bit. QE3 was all in. Let's flood the market with $4.5 trillion of money that we just printed up and see if that stimulates. And what we ended up finding out was it has some help, but toward the end of the program, the more money we put in, the less benefit we ended up. So it helped to an extent, but then it would take a lot more money to even get a little bit more benefit out of it. And so the Federal Reserve began cutting back. Now, to really understand where this idea comes from helps to understand the psychology of Ben Bernanke, who is the chairman of the Federal Reserve. The chairman and I had the fortune to serve together at the White House. When I was doing presidential personnel, he was the chairman for the Council of Economic Advisors. And leading up to the crisis, we thought he would be the best person to be Fed chairman because he is one of the world's preeminent experts on the Great Depression. And as you recall, under the Great Depression, President Herbert Hoover was defeated by FDR in the election in 1932. And the reason why that was a landslide election was Hoover took the position, we ought to be austere. The government should stay out of the market, let the market figure it out. We should do our role by making sure that we don't spend more money than we have, making sure that we have the correct policies in place that would encourage growth, et cetera. And the problem was, from 1929 to 1932, the economy experienced incremental progress, but not enough to where most Americans felt that there was enough progress. And so Roosevelt came along and said, I got a new deal. Enough of this austerity stuff. We are going to spend like crazy, and that's going to stimulate the economy. And we're going to have a new deal of which there's a chicken in every pot, and everyone will have a job. And if you don't have a job, we'll hire you to do these big public works projects like the Hoover Dam or rebuilding this bridge and all this other stuff. And that's the way that we get to the economy. But what he didn't anticipate was once he got into office, don't forget we had the gold standard at the time. And in the gold standard, you could only print as much money as you had gold for. And we had already printed all the money that we had gold for. So how are you going to stimulate the economy when you have no money? Within 3 months of him taking office, he put forth a controversial executive order that forced Americans to give up all their monetary gold, which meant back then you had coins and bills, and a lot of the coins had the amount of their value in precious metal. So in a silver dollar, you actually had $1 worth of silver in a dollar, and a $20 gold piece, you had $20 worth of gold in that $20 gold piece. And what he said was, Americans can't own gold money anymore. They have to turn it into the federal government, and in exchange, I will give them a $20 bill for that $20 gold coin. Overnight, all this gold started coming in, and he further said, I need even more money than this. The world's gold standard was $20 an ounce. He said, unilaterally, in America, that gold's going to be worth $35 an ounce. So what did that do? He started off with $4 billion of printed currency in the system, representing the $4 billion of the gold that we had. With these two moves, confiscating the gold and then increasing its value, he went up to $21 billion. And he had plenty of money then to spend on the New Deal, to fund institutions like the World Bank and the IMF, and other things that we still are living with. The legacy of the modern financial system was built during this amount of time. That is, I explain that because Ben Bernanke knows that. And so the great debate when he came into office was, if Congress and the president can't get their act together and can't get the economy moving, then what alternatives does the Federal Reserve have? And a Federal Reserve has the alternative of increasing or decreasing money supply. And increasing the money supply, in essence, acts like a stimulus. And so let's try that. The big part of history that hasn't been written yet is we don't know if it was Roosevelt's stimulus through the New Deal that turned around our country, or if it was World War II and the production of the military-industrial network that needed to produce all the war stuff in order to win that war that pulled our country out of the doldrums. So this is going to be debated for the next 25 to 50 years as to whether or not this experiment has really worked. So we're a work in progress. But it was amazing for me to not only have friends like Chairman Bernanke, but two people down, the dark-haired young guy on the right is Kevin Warsh, who was a White House staffer, and a dear friend of mine who then became a governor at the Fed, and the only one on that whole table that had actual Wall Street experience. All the rest of them were academicians economists that have studied this, but he was the practitioner and then played a critical role when the markets were collapsing, helping the Fed understand that. So based on what I know, and based on my experiences, and taking a look at the data now that I'm in a private sector and can pretty much say anything I want, what's happening now and how does that impact you? And I'm just going to do top line here. From my perspective, what's the near-term economic outlook? And there's 6 points that I want you to think about. And then we're going to have plenty of time for Q&A, so if you want to tease apart any of these points a little bit more, I'm happy to do that. Number one, the U.S. economy continues to recover, but it has a long way to go. Yeah. Make no doubt about it. Our economy today, as much as Americans don't feel it, is, from a data perspective, up from the depths of 2009. Things are better today than they were, 5 years ago. For example, the unemployment rate in 2009 hit a peak of 10%, and today it's 6.3. That's a huge, huge improvement over that period of time. But I would also argue that it's not as rosy as it seems, because if you compare where we are today to where we were before the crisis, we're a shadow of what the United States used to be. And so let me just give you the employment rate. It's great that we're at 6.3%, and I hope that gets to 5% over the course of the next 18 to 24 months. In 2006, before the crisis, we had an unemployment rate of 4.3%. Quite a long ways from 6.3. Further, one of the ways that unemployment rate has improved is there are fewer people in the workforce, yet the same number of jobs being created. And so when you reduce the denominator, it increases, it makes the number look better. And right now we have a record 92.5 million Americans who are working aged, who are not in the workforce because they've given up and they don't want a job. That number has not been as high or as great of a percentage of the population, and you have to go back to the mid-70s to find that number, right? So we've improved, but there's a long way to go, and we're still not back to where we were before the crisis. We're on the right track, it's just moving slowly. Second, but when you compare ourselves to the rest of the world, we are positively robust and in great shape. And that's the thing, and that's why you're seeing a very strong dollar out there right now. When you take a look at Europe, most countries in Europe are mediocre to bad, and the only country that's holding up everything has been Germany, and Germany has run into some problems in the last 3 to 6 months. And so there's a great fear in Europe that they might have a triple-dip recession coming up soon. In addition, China's been driving a lot of growth. China's growth is still above 7%, but now they're experiencing either flattening out in certain sectors like manufacturing to actual decreases like in their housing sector. And so that indicates that there's some slowing down going on. Whereas the United States, we might be incrementally improving, but at least our trajectory is moving up, where everybody else is flattening out or moving down. And so because of that, the United States looks pretty good compared to the rest of the world. Third, up until 6 months ago, there was very little volatility in the markets, whether it's the bond market or the stock market, even gold prices. They were always minor changes from day to day, and a 50 or 100 point swing was really unusual. Now you're seeing 300 or 400 point swings, and based on the data, this is only going to continue over the next 12 months. You're going to see much more volatility in the markets, which is great if you're a speculative investor, because when there's volatility, there's opportunity. But if you're a long-term investor, it's easy to get caught up in the day-to-day emotions of, gosh, the market crashed, what's happening to my portfolio, instead of looking at the long term. Fourth, this slower global economic growth could threaten the United States growth. After all, when you have a strong dollar, what that means is the dollar is so strong, imports are cheaper, and so American consumers benefit because something made in China or in Europe is going to be cheaper for us to buy, but it also hurts our jobs, because what that means is if China's making more stuff for us to buy because it's cheaper and we're buying it, that means China's jobs are growing and not ours. And so when China and Europe begin to hit some problems, that could, if the problems are severe enough, that could have a contagion effect on what's going on here in the United States. Fifth, the fundamentals are important, but what's dominated how the markets react have been Fed policy. And so now the Federal Reserve has made a big decision. They were tapering down its quantitative easing program to 0, which they voted on at the end of October. And now their big challenge is when to raise interest rates. If they raise them too soon, they could kill our very fragile recovery. If they raise it too late, they're going to be chasing inflation. And if you took the $4.5 trillion that they printed, and if that actually went into the economy, inflation would be 30% a year, right? And so there's a really big fear then, if they don't catch it right, then it shows it could take years for them to get the policies in place to put this back in the box again. So whatever the Federal Reserve decides will have a huge impact on the markets, and it's not necessarily tied to fundamentals. The second thing is you got this $4.5 trillion out there. They have to figure out a way to get that out of the economy before it becomes too hot. And nobody's ever figured out how to unwind a $4.5 trillion stimulus program before. It's an experiment that even if you look at the Federal Reserve FOMC notes, they will say, this is a great experiment. We're making it up as we go along. And so far, God has been with us, but we don't know how to resolve this. And that's the direction that we're headed in with the Federal Reserve. And then lastly, you're going to have increased risk over the next 12 months and even into the next 5 years of a negative impact black swan event. And what I mean by that, black swans are very rare and they're very unexpected. You can't breed them, and so they just happen. They're a surprise. And from time to time, there are surprises, both good surprises like the internet and bad surprises like 9/11, that dramatically impact markets and their structures and change them forever. And right now, the number of potential black swan events out there have dramatically multiplied in the last 5 years. Whether it is something as obvious as a terrorist attack from ISIS, to greater Russian aggression, to Ebola, all the way to things that you don't hear about, but I heard a lot about when I was at the Department of Treasury. I got almost a daily briefing from the FBI about things like cyber attacks. Virtually every day, there's a major cyber attack on some part of the banking system, let alone the financial system. And there's a fear then that someday they're going to be really successful, and we're going to, if everything depends on electronic commerce, and somehow there's a virus that prevents that, then what do we do? And we're unprepared. And so, I'm not saying that to frighten you, and I don't know, because if I knew, it wouldn't be called a black swan. But the number of potentialities are greater today than they were even a year ago. And what we have today are dramatically more than what was 5 years ago. So what does that all mean for you? So my conclusion is 3 things. Caution ahead. Don't worry about the day-to-day. That's why you pay professional wealth managers to figure out for you. Because believe me, with the increased volatility, you're going to be whipsawed from day to day on an increasing and greater magnitude basis over time if you worry about what happens from day to day. So if you don't worry about what's happening from day to day, what should you focus on? You should focus on the long term. I don't know when we're going to get out of this economic mess. We're certainly clawing our way out slowly now, but it could take 5 years, it could take 10 years, it could take 20 years, it could take 50 years for us to get out. But I have enough faith in this country to know that one day we will be out of this. And when that day happens, the fundamentals, like earnings, whether or not people buy those products, and all those things that normally influence the market, they will take greater precedent over Fed policy and all these other things. And so if you invest based on the fundamentals over a longer period of time, you're going to end up a lot better than figuring out what to do every time you get whipsawed. Lastly, diversification. When there's this much economic uncertainty out there, you don't want to make too big a bet in any one particular area. You want to have your investments spread out, so you spread out that risk, but you don't want to spread out into everything. You need to be able to target appropriate proportions of that portfolio into that diversification strategy. And so that's what I would encourage you all to think through as we approach over this next 12 months, because it's going to be a very interesting ride. And with that, if you at least found anything I said a modicum of being interesting, you can go to my website, edmoy.com, where I collect all my media appearances and op-eds and stuff like that. And you can also follow me on Twitter, because I comment a lot on daily financial news.